if the economy's healthy, the stocks go up by 10% a year. The S&P does. And if the economy's not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works, watch the interest rates for the last decade. It works until you crank the interest rates down to zero. It used to be overnight money was 550 basis points, Tom, before the great financial crisis. And then they cranked it down from 550 to 500 to 450 to 400 to 350 to 300 to 250 to 200 to 150 to 100 to 50 to zero. And now we have, the bankers say, I'm not even thinking about raising interest rates. So that breaks bonds as a store of value unless you go negative interest rates. And stocks work, except for the fact that, what stocks worked in the past decade? Apple, Amazon, Facebook, Google, a big tech company that grows 20% a year top line. When Apple stopped growing 20% a year top line, they fixed it by taking on massive amounts of debt, buying their stock back, and leveraging up their EPS. So companies that grow faster than the rate of monetary inflation, faster than the 7%, they could hold value. A company growing 20% like Google, Facebook, or Amazon, they all hold value. In fact, they accrete value. Why? Because 20 is more than 7, right? So it's plus 13% a year, right? What happens to all the other companies? Which companies in the S&P 500 amounted to all the indexes, or to all the gains? It was big tech, right? Big FANG stocks were the winners. Everybody else treads water because if you're growing at 7% and the money supply is collapsing at 7%, you're net zero. And how else do you get around it? Well, you can go borrow a lot of money, leverage up, buy back half your stock, and get your cash flow per share up. But what happens when you're fully leveraged, which is like where they are right now? You can't do it anymore. So what's the problem right now? The problem today is the currency is being devalued at 20% a year, not 7% a year, right? I turned up the heat in the frying pan. And the second problem is some stocks could hope to grow 20% a year, like the minority, 5% of them could grow 20% a year for the past decade. What percentage of stocks can grow 30% a year? Because now you got to grow 30 or 35% a year because the hurdle rate just jumped. Now you're pushed out on the risk curve here. You got to take massive risk as a company to grow that fast. You got to do acquisitions. You got to burn the candle on both ends. You got to take on massive new leverage. This is squeezing. Value stocks don't work, right? I mean, it squeezes you out of the value stock trade because if the company is reliable and it's growing its cash flows 5% a year and the money supply is expanding at 20% a year, cash is trash. Back to my story, right? Why is cash trash? Because I had a value stock with a lot of cash and the money supply is expanding. Look at it from the point of view of an investor. They can invest in the S&P 500 index or the NASDAQ, and those were all up like 40% year over year or something, Or they could hold cash and get 0%. Nobody wants to hold cash. And so they might as well just take it and put it into something else.